Welcome back. Today, we're going deep on Energy Transfer, a real giant in America's energy infrastructure. Now, for investors, this company is a genuine puzzle. It's dangling a dividend that is so high it's almost impossible to look away. But you guessed it, there's a pretty big catch. And there's the number right there, 7%. In today's market, that kind of dividend yield is like a beacon for anyone looking to generate income from their investments. It just screams opportunity. But is it just too good to be true? That's the million-dollar question, isn't it? We're going to try and figure out if this is a real undervalued opportunity or if it's a classic yield trap just waiting to snap shut. And to do that, we need to come at this from a few different directions. So here's how we'll break it down. First, we'll look at their business model. We're calling it the energy toll booth. Then we'll get into their latest financial results, which are, well, they're a little confusing. From there, we'll jump right into the heart of the bull versus bear debate. And finally, we'll look at what's coming down the road. All right, let's start at the beginning. Before we can even begin to judge that dividend, we really have to get a handle on how this company actually works. And the concept behind it is actually incredibly simple and pretty powerful. Energy Transfer is what we call a midstream energy company. And honestly, the best way to think about it is like a massive highway system, but for oil and natural gas. They don't pull it out of the ground, and they don't turn it into gasoline. They just own the pipelines, the toll roads that transport and store it, and they collect a fee for everything that passes through. And just take a look at the sheer scale of this thing. We are talking about more than 100,000 miles of pipelines crisscrossing the country. This isn't just a business, it's a vital piece of the entire U.S. economy. That size alone creates a huge moat around the business. I mean, once a customer is hooked into your pipeline, it's incredibly expensive and difficult for them to just switch to someone else. And here's the secret sauce that's supposed to make it all so stable. About 90% of their earnings come from these fixed fees. Think about what that means. They get paid based on the volume of fuel moving through their system, not on the volatile price of oil and gas. So whether crude oil is at $50 or $100 a barrel, that toll fee, it stays pretty much the same. This whole model is built to generate steady, predictable cash flow, which is exactly what you want to see from a company paying out a big dividend. So, with a business model that sounds so steady, you'd expect their finances to be rock solid, right? Well, this is where the story gets complicated. The company's most recent earnings report threw Wall Street a real curveball. Just look at this. On the one hand, their revenue was better than expected. Great, more money is coming in the top. But then you look at profit, the earnings per share, and it missed expectations by a mile. So how does a company bring in more money but end up with way less profit? That is the absolute core of the problem here. So here's the conflict in black and white. Operationally, the business is on fire. Their pipelines are moving record amounts of energy, more than ever before. The system is working perfectly. But financially, something is off. Their profit margin is getting squeezed, which just means it's costing them more to do business. And it's that exact disconnect that has investors completely divided. Which leads us straight into the big debate, the bulls versus the bears. You have two groups of very smart people looking at the exact same set of facts and coming to totally different conclusions about where this stock is headed. So let's hear both arguments. First up, the bulls, the optimists. They're looking at Energy Transfer and seeing a company with some serious growth engines about to fire up, but they believe the market is totally overlooking it. They think these current problems are just temporary bumps in the road. The bulls see a very clear path forward. Maybe the biggest catalyst is the AI boom. Think about it. All those data centers need a staggering amount of power, and it has to be reliable, 24/7. Natural gas can provide that in a way that other sources just can't. Deals with huge companies like Oracle might be just the tip of the iceberg. And on top of that, ET is pouring billions into new projects, and the whole energy sector itself looks pretty cheap right now. And you can just hear the confidence coming straight from the top. The co-CEO, Mackie McCrae, is basically saying, look, our network is so huge and so flexible. If you need natural gas, we can get it to you, period. It's a pretty powerful statement about their position in the market. And that confidence is being echoed by some analysts. A few on Wall Street have price targets as high as $25 a share. You know, from where the stock is today, that's more than a 30% jump. And that's before you even factor in that big dividend. Okay, but the bears, they see a completely different movie playing out. For them, everything circles back to that beautiful dividend and one very, very scary number that makes them question if it can last. And here it is. This is the number that is giving the bears nightmares. A dividend payout ratio of over 110%. Just let that sink in. It means that for every dollar the company is earning in profit, it's paying out more than a dollar to shareholders. Now, to be fair, companies like this often use a different metric called distributable cash flow, and that number can look a little bit better. But if you're just looking at standard net income, this is a huge red flag. So, to put it as simply as possible, the bear's main point is this. The company is not earning enough money to safely cover its dividend, and that creates the very real risk that they might have to cut it, which would almost certainly send the stock price tumbling. And the dividend isn't their only worry. We already talked about those shrinking profit margins. Plus, they're spending billions on these giant new pipelines. And big projects always come with execution risk. The chance of delays or cost overruns or just not getting the payout you expected. Throw in the constant threat of new regulations, and you can see why the bears think the pile of risks here is just getting too high. So, with these two completely opposite views, how does this actually play out? Well, no one knows for sure, but there are some really clear signs that we can all watch for to see who's right, the bulls or the bears. The entire bull argument really rests on this growth timeline. These are the big projects that are supposed to bring in a flood of new cash and make that dividend safe again. The question for investors is pretty simple. Can they get these projects up and running fast enough to fix the profitability problem before it's too late? And in the immediate future, here's what you want to keep your eyes on. The next earnings report, coming out in late April or early May, is absolutely crucial. You've got to watch those profit margins like a hawk. Pay close attention to every word management says about the dividend. And look for any news about more deals to power those AI data centers. Those will be the first real clues. And that really leaves us with the bottom line. This company is in a high-stakes race against time. Can all that future growth from AI and new pipelines solve the profitability puzzle before that massive dividend becomes a liability they can no longer afford? That is the high-yield dilemma at the heart of energy transfer right now. So that's the story of energy transfer, a stable business model facing a very modern problem. We've laid out the best arguments from both camps, but this story is far from over. The only question left is, which side makes more sense to you? Thanks for joining us for this explainer.